This is the Retirement Lifestyle Advocates radio program. I am your host, Dennis Tubergen. Glad you decided to listen in today. Hey, joining me on today's program in the second and third segments of today's program is first-time guest, Mr. Egon von Greyerz. Egon is the founder and managing partner of Matterhorn Asset Management. I caught up with Egon this past week from his offices in Zurich. I've been a longtime follower of Egon's work. It was really a pleasure to interview him, and I know you're going to appreciate his perspective. And again, that's coming up in segments 2 and 3 of today's program. It is still March, which means if you have not yet ordered the March 2023 special report, you don't have much time left to do so. The March 2023 special report is titled Social Security Tax Reduction Strategies. The report contains many different Social Security tax reduction strategies. If you are currently collecting Social Security, if you are planning for your retirement, if you aspire to collect Social Security and maximize your benefits from Social Security by minimizing your taxes, this report has information in it that I know you're going to find valuable. To get your copy of the report as well as some bonus information, visit requestyourreport.com. The website, again, is requestyourreport.com, and when you visit the website, you'll just have to let me know where you would like your report mailed. And when you request the report, I'll also get you copies of a couple of my best-selling books. In keeping with the Social Security theme, I'll send you a copy of the Little Black Book on Social Security Maximization, and I'll also send you a copy of the Revenue Sourcing book that contains a retirement planning strategy for today's economy. So again, to get all that information absolutely free and with no further obligation, just visit requestyourreport.com. Now, certainly the dominant headline is banking failures. And I want to talk about that a bit in this segment. You know, the first bank to fail, Silicon Valley Bank, we have talked about on the podcast last week. Just a couple days after Silicon Valley Bank became the largest bank failure since 2008 at the time of the financial crisis, state regulators closed Signature Bank in New York. That was the third largest bank failure in the country's history. So needless to say, this has been dominating the headlines, probably dominating your thoughts. You're probably wondering about your bank, and I'm going to talk about that in this segment. Now, like Silicon Valley Bank, Signature Bank had a lot of uninsured deposits. Now, as you all know, FDIC, the Federal Deposit Insurance Corporation, insures bank deposits up to $250,000 per tax ID number per person. Well, when you take a look at Signature Bank had $110 billion in assets, $89 billion in deposits, but $79 billion of those deposits were not insured. So these banks largely served, for the most part anyway, large depositors. Now, on the heels of the Signature Bank failure, we had headlines of Credit Suisse. Credit Suisse's shares halted trading. They needed to get a lifeline. They finally were able to borrow $54 billion from Switzerland's central bank. So they now are taking, they say, action to strengthen their financial position now that they could borrow more than $50 billion to bail themselves out. And then, of course, many of you have probably heard about First Republic. First Republic needed a $20 billion bailout, and a number of other banks are stepping up to bail out First Republic. And as a side note, the Wall Street Journal reported that First Republic Bank executives sold $12 million in stock just before the bank failed. So that is a bit suspect, and hopefully there are some investigators that will get to the bottom of that. So no shortage of banks having financial issues. Now, there is an interesting backstory when it comes to Signature Bank, because after the financial crisis, there was a bill passed named after Christopher Dodd and Barney Frank called the Dodd-Frank Act. And this Dodd-Frank Act was to put in place regulations to keep bank failures from happening again. Now, Barney Frank, one of the co-authors of this legislation, the Wall Street Journal reported this past week. In fact, this was reported on March 13. And I'm going to quote from the article, quote, "Life is full of irony, but it's hard to think of a richer one than Barney Frank sitting on the board of the failed Signature Bank." Yes, that is exactly what happened. Barney Frank was on the board of Signature Bank. Now, the journal goes on to say, quote, "It's amusing to think of Mr. Frank cashing a check as a bank director, but then even left-wing former congressmen have to make a living. And in Mr. Frank's case, it's been a nice one, with cash compensation of $121,750 and stock awards of $180,182 in 2022 alone. And Mr. Frank has been on the board since 2015. Now, Frank was asked about why he was on the board, and he simply said, "I need to make money." He told Financial Times, quote, "I need to make some money." Frank has, I said, been on the board since 2015. He told the Financial Times, that because he declined a congressional pension, he needed the income. Now, according to an article on Zero Hedge and confirmed by the Wall Street Journal, Mr. Frank made about $2.4 million while serving on Signature's board. Now, interestingly, he was a bit disappointed that regulators came in and took a hard line. This bank, Signature Bank, had been investing in crypto, or had been involved in the crypto market. So certainly not a conservative posture that the bank was taking. Mr. Frank told Bloomberg, quote, "I think that if we'd been allowed to open tomorrow, that we could have continued. We have a solid loan book. We're the biggest lender in New York City under the low-income housing tax credit." And Frank is wondering why regulators took such a hard line. Now, the journal speculated that maybe the regulators decided to roll up Signature Bank because of its crypto association. Now, interestingly, here's a guy that wanted to make banking more conservative. And yet, if Mr. Frank has been on the board of Signature since 2015, at that time in 2015, you could take a look at where crypto was selling. And if you take a look, for example, just at Bitcoin in 2015, it was $250 to $300 per Bitcoin. It rose as high as $63,000 before now falling to about $20,000. Hardly a non-speculative investment. Now, I would encourage you, if you're concerned about banking, one, check your bank safety ratings. Two, diversify deposits among banks. And three, use deposits with insurance companies and money markets potentially as an alternative. Now, don't take that as advice. It's not intended as advice, but do your homework and diversify. I'll talk more about this in the next segment with my special guest today, Mr. Egon von Greyerz. You'll want to stay tuned for that, and I'll be back after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubergen. Joining me today on the program is first-time guest, Mr. Egon von Greyerz. Egon is the founder and managing partner of Matterhorn Asset Management. I'm catching up with Egon today from his offices in Zurich. And Egon, I've been a long-time follower of your work. It's a pleasure to have you on the program. Welcome.
Well, Dennis, very good to speak to you for the first time. Yeah, yes. So, well, yeah, a lot to talk about these days, and which makes your job interesting and mine too.
It certainly does. And let's maybe start, Egon, with just a little bit of background. And let me just mention to the listeners that if you'd like to learn more about Egon's company and what he does, you can go to goldswitzerland.com. That's goldswitzerland.com. Egon, can you tell us just a little bit about Matterhorn Asset Management? What motivated you to start the company, and what do you do for people?
Yes, so at the end of the 1990s, I was worried about which I often am. I'm worried about the world, but worried about the debt exploding, and worried about derivatives. So and that was at the same time as gold was bottoming, had gone down from $850 to $250. So and I thought that this was the time to really worry about the safety of your investments and of the financial system. So we started then with that for ourselves and the few investors that we advised at the time to focus on wealth preservation in the form of physical gold and silver stored outside the banking system in the name of the client. So we started going into gold in a major way in 2002 when it was $300. And really, we haven't turned back. Obviously, we got the first crisis, 2006-08, and gold rose quickly from 300, as you know, to over 1900, and then it's been going sideways for a while. But the good thing with gold is that it always goes up, of course. Or if we turn it around, paper money always goes down. And that's what really is happening because gold is just stable purchasing power. And that's why we found that we thought it was absolutely critical in the coming years in a system which is where we have bubbles in every asset class, bonds, stocks, property, and we think there will be major corrections in all of these. And we felt like gold was the best way to insure against this and to protect your wealth. But obviously, you mustn't keep it in paper form or in a system that is bankrupt. And we've seen examples of that just in the last few days. So therefore, you have to have it in very safe vaults outside the banking system, and preferably outside your area or where you live also, or the country where you live, so you can actually flee to your gold if things really get bad. So that's what we started 20 years ago, and we have clients all over the world. We have the biggest gold vault in the world, in a private gold vault in the world, in the Swiss Alps, which that's for clients. The smaller vaults for normal size clients, but our minimum is quite high. It's $400,000 in the smaller vaults, and then $5 million in the mountain vault. So that's in a nutshell what we do, Dennis.
Well, Egon, thank you for that explanation. I caught an interview you did a couple of weeks ago, and during that interview, and I've seen you write about this as well, you mentioned that $2 quadrillion in global debt looms over our markets, and I believe that's the term that you used. First of all, a quadrillion is a number that, in my mind, is unfathomable. I can't even get my arms around how much that is, and that can't possibly be paid. And can you explain to the listeners a bit about what you mean and how you arrive at that number?
Yes, it's really very simple. If we start with global debt is around 300 trillion today. Just at the beginning of this century, it was just under 100 trillion, and it's gone up 3 times just in the last 20 years. And of course, if you go back 50 years before Nixon closed the gold window, of course, global debt was just a fraction of what it is today. So we have now, for the ones who were born before 1971, we've experienced a period of debt explosion that has never happened before in history on a global basis, which is what we're seeing now. It's everywhere. It's not just America or Europe, but it's or Japan. It's in every country in the world. And so that's the 300 trillion debt first, and then the derivatives. I mean, the derivative. In my estimation, the derivatives outstanding are probably 1.5 to 2 quadrillion. Now, I'm saying that because about 12 years ago, the Bank of International Settlement was the central bank of all central banks, and they reduced the outstanding derivatives just with a stroke of a pen from 1.2 quadrillion to 600 trillion. But that was just that was actually fake accounting. The gross outstanding figure was still 1.2 quadrillion, and since then, this was, as I said, over 10 years ago. Since then, there's been a massive growth in derivatives. You know, every single transaction today has elements of derivatives or all derivatives in them, and a lot of lending is taking place through the shadow banking system also in the derivative market. So therefore, I'm saying that these derivatives are going to, and they're also very interest sensitive, and therefore they're under a lot of pressure now because of the higher interest rates, which haven't been really taken into the risk calculations. So therefore, the outstanding derivatives is, as I said, 1.5 to 2 quadrillion, and I think just like we saw now a number of banks having to be saved by it was really by the FDIC, or with Fed's intervention, and Bank of England in England also. But just like they had to be saved, although it wasn't a formal bailout, but in the end it will become a bailout anyway because FDIC hasn't got the money. And the same will happen with the derivatives. They will fail when counterparty fails, and then those derivatives will fail, and therefore somebody has to step in. And what I'm saying is that these derivatives will actually turn into debt, and central banks will have to step in to buy this debt or to support the banks that will be failing otherwise. You know, the big U.S. banks, they all have. You know, they report. If you take J.P. Morgan, it's the biggest with over 50 trillion of derivatives, and I think that will actually turn into debt. And this is how the 300 trillion becomes over to 2 quadrillion in coming years. I'm quite convinced that that's going to happen. And of course, at the same time, then what central banks will do around the world, they're working on it now. They will turn the money that our fiat money system now, they will turn that into some digital money. They'll try to pretend that they can park the old debt somewhere else. And now we have new money. And then at the same time, of course, this digital money is wonderful for every government because they can then control us totally with all the spending and what we do and finance and the taxes, etc. So that's what risk is that we'll see in the next few years. And as I said, that's how the debt will totally explode. And of course, if we get to that level of money printing, and I think there's a high risk we will, of course, there will be inflation or hyperinflation also. There has to be. You can't print that much money without creating inflation. So it's a pretty dire prospect that we're looking at. But you know, I'm not a prophet of gloom and doom. I'm an optimist actually. But you know, my speciality, if you want, what I'm interested in is understanding risk. And in my view, the risk is higher today than it's ever been in history, and therefore you've got to protect against that risk. I hope I'll be wrong. I doubt I will be, but I hope I will be. In any case, you know, I'm going to take investors or people who just have money in the bank. They've got to now start thinking about taking protection because, as we've just experienced, you know, those banks are not safe. Now, the first little banks, and they're not that small, but the Silicon Valley Bank and the Silvergate Bank, I mean, they could be saved by the system. But once it starts, you know, with bigger banks, and we know that most banks are under pressure, and some are under more pressure, like Credit Suisse in Switzerland, for example. And when that pressure mounts, you know, and we get a chain reaction, they're not going to be able to save the system. Or if they do, they'll print so much money that the money will be worthless. And that's the risk we have. And that's why investors should be very careful and not keep any major money in the bank, in my view. Much better to hold gold than keep it outside the banking system.
Well, I'm chatting today with Mr. Egon von Greyerz. He is the founder and managing partner of Matterhorn Asset Management. You can learn more at goldswitzerland.com. And Egon, we've got just 2 minutes left in this segment. You mentioned a central bank issued digital currency, and you mentioned that, in my view, the reason politicians want it is obvious. It's control. But do you see that actually becoming a reality? Do you think they're going to be successful?
No, I think it'll fail. But of course, digital currency is just another form of fiat money, so it will totally fail. They will try it. My view is actually that they might not even have time to do it properly, because although they're working on it, it's going to take much longer to implement than anybody thinks, and therefore we'll have some kind of half measure coming up in the next few years. But I think the system will overwhelm them and the collapse of the system, and therefore I think digital money will not get an orderly start, so therefore, everybody talks about resets, and they're going to be reset. Everybody defines reset differently. In my view, the only reset that's going to count is the disorderly reset. That's what we're going to have, when there will be panic and when people will lose money within the system, we have to have a cleansing of the financial system. The world cannot continue to grow soundly with a system full of massive bubbles and fake money and fake promises. So that's sadly what we're going to see in the next few years.
Well, the clock says we have to leave it there. I'm chatting today again with Mr. Egon von Greyerz, the founder and managing partner of Matterhorn Asset Management. I'll continue my conversation with Egon when RLA Radio returns. Stay with us. You are listening to RLA Radio. I'm your host, Dennis Tubergen. I have the pleasure of chatting today with first-time guest here on the program, Mr. Egon von Greyerz. He is the founder and managing partner of Matterhorn Asset Management. I've been a longtime follower of Egon's work, and it's a pleasure to chat with him. And Egon, you had mentioned in the first segment that all this currency creation by central banks has created huge bubbles in asset markets. Can you just talk a little bit about how overvalued you think these markets are? Maybe just talk about stocks and real estate to start. Well,
sadly, the investing has just been too easy in the last few decades, and especially in the last 20 years, because of the massive amount of credit creation and money printing that central banks have produced around the world. And as we know, until very recently now, when every central bank worked on getting, and especially the Fed, of course, and the ECB in Europe, they all worked on getting inflation up to 2%. And then overnight it went from 2% to 10% in Europe and 8-9% in the US. Now artificially the US one has come down a bit, but in inflation is going to continue up. And I think, I experienced it in the 1970s in the UK when we had inflation average 17% for 8-9 years. And I think we're in for a period of high inflation, high interest rates now. But anyway, it's this coming back. So we've had this money printing that has created these massive bubbles, because all the money that was printed by the central banks, or also, of course, commercial banks do most of the money printing by extending credit and by blowing up their balance sheets. And all that money went into to investment assets, and not into the consumer economy, and therefore inflation rates for the way that we measure inflation in the West, and of course that was falsely manipulated or changed in the 1980s. But the way we measure it now, of course, there has been no consumer inflation, and it was below 2% everywhere. And all of a sudden, the result of this massive money printing then turned into inflation in the last couple of years. But anyway, so that went into assets, and that's why assets just went up and up and up. And, the generation has been investing for the last 20, 30 years. They don't understand anything else, but that asset markets always go up, of course, because of the very friendly central banks we have around the world. So that's why we have created bubbles. In my view, when markets correct, they always correct more than they should, and I think we will have. I wouldn't be surprised to see a correction in the stock market, which was as big as in 29 to 32, which was 90% for the Dow Jones. And then the circumstances were nowhere near as severe as they are today, with debts and banking system, etc., and money printing. So that's why it would be totally normal, in my view, to see a 90% correction there. And this because of all this debt that is backing it. The same in the property market. I see property coming down by 75 to 90% also. And the biggest bubble of all is, of course, the bond market. That was also the banking crisis we saw now in Silicon Valley in the last few days. That actually also was because of the bond market. You take, I know you're a pension specialist, you take these banks that got the money from these Silicon Valley companies, the funds that they raised, and the bank puts it into long-term bonds and government bonds. I mean, that is the most foolish investment that anyone could ever do. First of all, government is never going to pay back the bonds ever with normal money. The only way they can pay that back is with printed money. And if those bonds run for 5 or 10 or years or longer, that money is going to be worth nothing that they're going to pay in 10 years' time, because inflation or currency or debasement of the money will totally kill the value of that money. So therefore, and then, to buy long-term debt, and when rates are just 1-2% or 3%, I mean, it's just as ridiculous. It's criminal. But people don't understand that, these low rates were just totally artificial, orchestrated by the central banks. So that's why, as I said, all this money went into those assets, and these assets are not going to correct now. Bonds, property, and stocks, but they're all 90%, 75 to 90% of them, and a lot of the bonds will be worthless, of course. Like bonds always become worthless in the end. And when and they have been backing the assets, and therefore the assets that were backed by all this debt will also come down. So we need this correction. That's the only way from which the world again can grow soundly, and that has to be done. And in the meantime, the world will suffer for a number of years, but then we'll come out on the other side stronger. But the transition will be horrible for the world, for all of us, of course.
Egon, let me zero in on your specialty. Let's talk a little bit about gold and understanding really that, pricing gold in fiat currency is a bit misleading, but just talk a little bit about where you see gold going and the best way to own gold for our listeners that have interest.
Well, yeah, it's a good question, Dennis. And what most people don't understand is that gold is the only money that has ever survived in history. In every period of history, going back thousands of years, each single currency always went to zero, without exception. There's no money today that exists in the form that was originally created that has survived. So that's why it's so simple. If you know that the money you put in the bank in 5 years' time, or 10 years' time, or longer, you know that that's going to be worth just a fraction of what it is. So if we measure money in gold, you take the dollar, but it's the same with all currencies. Since 1971, all currencies have declined between 97 and 99% in stable purchasing terms, which is what gold reflects. So imagine if you put a dollar today, $71 is today worth 2 cents. Then, and if people understand that, and that's happening all the time with every currency throughout every period of history. Obviously, talk about the longer term. It'll be shorter term. You can have fluctuations. The long term, that's why. But banks don't like gold because they don't make any money on it. Asset managers don't like gold either because they like to churn commission and trade, and therefore nobody recommends gold. But if you think about it, if you actually want to preserve your wealth, you don't, and that's most people don't. I'm not talking about, in real purchasing terms, that all you need to do is to buy gold and hold gold for the longer term, not for speculation. You don't ever buy gold for speculation. You don't buy it to sell it in a month or 2 months time. You buy it, you put it aside, you forget what, you measure it in ounces or grams or kilos, and not in dollars or euros or yen. And then you know that over time, you will always do better than any paper money and most other assets also, because and especially because now you're going to see all these bubbles. Sometimes, of course, stocks do very well and property do well, as it has done now. But that period is finished, and we're going to see these big corrections. And that's why now, it's not. I tell people, please, not for our sake, and you buy it wherever you want, but please own some gold and keep it as insurance. Imagine if the Venezuelans had done that 20 years ago. They would have been, they would have had money for the rest of their lives if they'd done it, even if they had just saved a little bit, or the Argentinians, or all the other people who've gone through hyperinflationary periods. It's only then people realize how important it is to protect your money and to own gold. I've got so many people coming to me having been through hyperinflationary periods, like in the former Yugoslavia, for example. They said, tell your clients, tell everyone they have to own gold, because all of my friends didn't in Yugoslavia and they lost all of their money. But sadly, people think that trees grow to heaven, and therefore they're going to make money. The stock market will always come back, and it only goes up. The property market too. That's not going to happen now, and therefore the people who don't protect themselves now are going to have real problems in coming years, sadly.
Egon, we have time for one more question here. Can you address confiscation risk? I'm thinking back to some of my history studies, and here in the United States in 1933. Then President Franklin Roosevelt made it illegal for American citizens to own gold. Do you think that's a possibility? And if so, how would one go about protecting themselves from that risk?
Well, it's always possible, but it's a very archaic method of confiscating money, in my view. The governments have a most wonderful way of confiscating money. Well, one is through inflation, of course. And i.e. the value of the money goes down all the time. But secondly, the best way is taxation. And rather than, you remember, gold in 1933 was only confiscated, or people were not even, that wasn't even confiscated, but it was actually people Americans were forced to sell it back to the government at around $21, just under $21, and then after that, because the U.S. government needed to devalue its currency, and the gold was backing the currency, and therefore the only way to devalue the currency is to revalue gold when you have official gold backing of the currency. So that's what happened, and then gold was revalued to 35, and the dollar obviously then devalued. But I don't think that now gold is backing no currency at all. So I don't think that's the way they would do it. Instead, they will actually do it through taxation. people have to remember now that every government around the world is running bigger deficits, and they're going to be even bigger because when all these bad debts materialize, and governments and central banks have to support all of this debt. So therefore, they are going to increase taxes, and that's the way to confiscate money. So taxes is what people should worry about. So tax planning is just as important as investment planning, and obviously anyone who, of course, for normal people, wage earners, they can't really do anything about their taxes. But for anybody who has the ability to actually do something about or plan their taxes better, I think they should do, because that's what government's going to do. Where the low taxes we've had now, they're not going to last. So we'll have very tough times in coming years. I mean, I always say, some people listen to me and say, well, he's the prophet of doom and gloom. But I don't see it that way. All I'm doing is just judging the risk in the world, and just telling people, try to protect against the risk by holding the only money that's ever survived in history, and that's really. And then I always say to people also, remember that the best things in life are free. That's friends, family, nature, music, books, etc. That's really, in bad times, all of those things are much more important than money. Although you need, of course, money to enough to eat and have a roof over your head. But except for that, all of those other values are much more important. We've been too focused on money for in the last 50 years or so, and on the golden calf. And I think that these other values are so important. People mustn't forget that.
Well, that's a terrific sentiment on which to end. Couldn't agree more. My guest today has been Mr. Egon von Greyerz. He is the founder and managing partner of Matterhorn Asset Management. You can learn more at goldswitzerland.com. Egon, it's been a sincere pleasure to chat with you today. Appreciate you sharing your perspective with our listeners, and I'd love to have you back down the road.
Dennis, very good to talk to you. Thank you for having me on your show, and I'd love to be back. Thank you.
We will return after these words. This is Dennis Tubergen, your host. You are listening to the Retirement Lifestyle Advocates radio program. Thanks again to my special guest today, Mr. Egon von Greyerz, for joining me on today's program. In this segment, I want to talk about taxes, and Egon, at the close of the last segment, talked about the importance, in his view, of doing tax planning. Well, if you dig into Biden's budget proposal for fiscal year 2024, you find not only is Mr. Biden proposing a $6.8 trillion budget, which is an almost unfathomable amount of spending for a year, but there's also nearly $4.7 trillion in new tax hikes being proposed. That's according to Americans for Tax Reform, and I'm going to talk about that in this segment. Before I do, if you are just tuning in, I have a March special report available for you. The March special report is titled Social Security Tax Reduction Strategies. To get your copy of the report, all you need to do is visit requestyourreport.com. The website again is requestyourreport.com. So this 2024 budget, which will likely not pass, in my view, in its current form, has $4.7 trillion in new taxes. Well, the first big item is that Biden is calling for a top federal tax rate of about 45%. Now, that would be the highest since 1986. So you've got to go back 37 years to find a tax rate that high. Now, Biden is also proposing that capital gains taxes will go up. In fact, if he gets his way, we will have the highest capital gains since 1978. I should say the highest capital gains tax since 1978. Americans for Tax Reform point out that Biden's plan nearly doubles the capital gains tax rate for investment to 39.6%, up from the maximum now of 20%. So if you take a look at the combined capital gain tax rate, the Obamacare tax, and add state taxes on top of it, you would see a number of states where you would have capital gains taxes approaching 50% of the gain. Corporate taxes would go from 21 to 28%. Communist China, just for reference, has a 25% tax rate. That's, again, a federal tax. If you add in state taxes, the corporate tax rate now goes to 32%. There is another rather controversial proposal. Biden is calling for a 20% minimum tax on the unrealized gains of individuals with income and assets that exceed $100 million. Now, it may start there, but mark my words, if it passes, that threshold will decline over time. The income tax, when it actually became a reality in 1913, if you adjust for inflation, the income tax would have only affected those making more than $12 million a year in today's dollars. Now, just about everybody pays income taxes, and if you work, you certainly pay Social Security and Medicare tax. I believe capital gains taxes should only be sold when an asset is sold. Now, Biden is also calling for new taxes on oil and gas, totaling $31 billion, and he's proposing raising the Medicare tax from the current 3.8% to 5% for some taxpayers. There's also proposals for a retirement tax, capping the amount of money you can have in a retirement account. So this whole proposal is filled with a lot of crazy things. So if you've not yet requested the special report for March, which is titled Social Security Tax Reduction Strategies, that's a great place to start. And when you request that report, I'll also send you a copy of the Little Black Book on Social Security Maximization, and I'll also send you a copy of the Revenue Sourcing book that contains some tax planning strategies as well. To get that report, visit requestyourreport.com. That's all the time I have for this week. I will be back again next week. Have a great week.